We're going to be talking about bond supply, bond demand, and equilibrium in the bond market. We're going to construct a simple demand and supply model to explain why bond prices change and why the return on bonds change, and how considerations of risk affect bonds. So like any demand and supply model, we begin by talking about the factors that affect the supply curve and the factors that affect the demand curve. Then the last step is to bring demand and supply together and talk about equilibrium. So the factors that affect bond supply: one, the obvious one, for US Treasury bonds. If the US government needs to borrow more, it creates more new Treasury bonds and puts them out to auction and injects those bonds into the market. So that would cause the supply curve to move to the right. Second thing, if businesses perceive better economic conditions, then they will feel confident to invest and expand their business in anticipation of profit opportunities. One of the ways to finance new investment is to borrow, and one way to borrow is to issue new corporate bonds. So better economic conditions can lead to an increase in corporate bond supply. Third thing is an increase in expected inflation. Now, if we assume for the time being the prevailing nominal interest rate in the economy remains the same, then if expected inflation goes up, that makes the real cost of borrowing lower. Remember the Fisher equation? So an increase in expected inflation will cause bond supply to increase so long as the nominal rate of interest stays the same. Now we will talk about the factors that shift bond demand. We're talking about the demand curve. The first one is total wealth in the economy. Let's suppose the economy grows, people become wealthier. They naturally want to store a share of their increased wealth in the form of bonds. Then it's like the pie, the portfolio gets bigger. So bonds being a slice of the pie, a slice of the portfolio. As the portfolio of all the people in the economy gets bigger, so too do the number of bonds. So the demand for purchasing bonds will increase if wealth in the economy increases. Other things that affect bond demand include expected inflation. If the nominal rate of return on a bond remains the same and inflation is expected to increase, then the real rate of return on owning a bond falls, and that means that the demand for bonds will fall. Fewer people will want to buy a bond if the real return is lower. The third thing is expected returns and interest rates on competing substitute assets. If the expected return on competing assets goes up, that will cause a fall in the demand for bonds. If the expected returns on substitute assets falls, then it goes the other way. Demand for bonds would increase. Number 4, risk relative to alternatives. Of course, if competing assets become more risky, then bonds look more attractive, and vice versa. Number 5, the liquidity of a bond can change. That's the ability to trade a bond and convert it into cash quickly. If a certain type of bond becomes more liquid for some reason, that makes it more attractive, demand will go up. Less liquid, demand will go down. Let's talk about why bonds are risky. Now, the important thing to remember is the way our kind of bond is set up is a promise to pay fixed nominal payments on a fixed schedule. So you're promising to pay dollars, and that is a nominal amount, and that amount is fixed. So, three kinds of risk. One is default, of course. You are not able to make your payments. That's a risk. It's a risk to the buyer of the bond. Second thing, inflation risk. If I'm promising to pay you, the buyer of my bond, a fixed nominal rate of interest, and inflation goes up, you are worse off because your real return has fallen. Number three is interest rate risk. This kind of risk will only matter if you buy a bond and you are planning to sell it before the maturity date. If you're planning to hold the bond you bought all the way through to the maturity, this risk does not apply to you. You buy a bond at the prevailing 6% nominal interest rate. That's what you're expecting this bond to be returning for the entirety of its term. So you've gone into the purchase expecting a 6% return, and 6% is also the appropriate discounting rate for the future payments, because that's what the rate was when you bought the bond. Now let's suppose after you have bought the bond, the prevailing nominal interest rate in the economy unexpectedly increases. Now, you are going to find that if you discount all those promised fixed nominal payments, their real value has fallen. And if you go onto the market trying to resell your bond, the dollar price you receive will be lower than you had expected. That's what we mean by interest rate risk. Now, the textbook has an example explaining this. But the basic concept is, if prevailing interest rates in the economy unexpectedly go up or down, they affect the market value of a bond should somebody try to sell it. And depending how it goes, you could end up making an unexpected capital gain or an unexpected capital loss in the event of trying to sell the bond. This number 3 point is the hardest one to understand, and that's why the textbook has an example. This interest rate risk is greater when you're dealing with a long-run bond, a bond with a very long maturity. The reason is that the longer the maturity of the bond, the greater is the risk of an unexpected interest rate increase or decrease. Everything else equal, longer run bonds with a longer term to maturity, have more interest rate risk. At this point, let me introduce you to the Wall Street Journal pages that give information about prevailing market interest rates and other financial variables. So here you see a little cutout from one of the pages in the data section from the Wall Street Journal. See the Treasury yield curve there. The yield curve is the expected rate of return for a bond bought at like 1 month or 3 months or 6 months or 1 year or 2 years, 3 years, 5 years, 7 years, 10 years or 30 years. You notice that over the long run, a longer run bond has to be promising a higher yield. And the reason a longer term bond has to promise a higher yield is because the longer the maturity of the bond, the higher is the interest rate risk. So that upward curve that's called a yield curve is a reflection of the reality that the longer the term of a bond, the more risky that bond is to buy. It's more risky to buy because over the longer run, more unexpected things can happen. We are relatively confident that over the next 3 months, nothing drastic will change with interest rates. But 30 years from now, 10 years from now, we are less sure what future interest rates will be. By the way, look at the little graph to the right of the Treasury yield curve, the foreign exchange one, the Forex. There are 3 exchange rate indicators there. The blue one is for euros, the green one is for the United States dollar, and the sort of reddish one is for the Japanese yen. Look at the pattern there. Those indicators are for the value of the euro or the dollar or the yen relative to the corresponding currencies of its biggest trading partners. Now for the US, the European zone, the Eurozone, is a big trading partner. So it's only natural that if the red line, the US dollar value, falls, then automatically you expect the euro line to be going up because it's relative. It's dollars versus euros, basically. So if the dollar's going down, the euro naturally is going up. And if the euro is going down, there's going to be a inverse correlation with the US dollar. The US dollar will be going up. So you see there that those are the 3 interacting indicators for foreign exchange value. The Japanese yen doesn't correlate so well with the US dollar because Japan is a smaller component when we are measuring the value of the US dollar against trading partners. This gets me to a much broader point. When you look at these numbers, these yields and exchange rates and so forth, all these things are in effect market prices of a sort. An interest rate is a sort of market price. An exchange rate value is a sort of market price. And all of these market prices have to move in a rational relationship to other market prices. If they did not move in a rational way relative to other market prices, it would be possible for an arbitrageur, through arbitrage, to exploit the inconsistency and make a lot of money very easily at no risk. So think of these yield curves, interest rates, foreign exchange rates, and so forth as really having a logical story behind them. Even though we can't predict the future, we can predict the relationships that these different market prices for financial assets have with respect to each other. A more concise way of saying the same thing is you can look at the foreign exchange graph there and you can tell a story. You can look at the yield curve graph and you can tell a story about what's behind it. That's what we're aiming to be able to do. Here's another part of another page from the same day, and you see the sort of data that relates to tracking bonds, and I'll just talk about the diagram that says global government bonds mapping yields. Now, yield is sort of like the return that you expect to get from buying one of these bonds. And as we've talked about, yield should have a rational relationship to risk. So you see on the right there these are government bonds issued by different governments like the United States, Australia, France, Germany, and so forth. And by looking carefully at differences in yields, you imagine that behind the scenes there's some story. So, for example, US bonds have different yields from Australia bonds. Now, that could reflect different reasons. One reason is perceived riskiness. The riskiness may not be riskiness of default. We don't normally expect government bonds from these major countries to default, but there is still the other sorts of risk, like interest rate risk or inflation risk. So that's why bonds from different governments, which have different currencies and different national interest rates, will have different yields. Let me finish off by referencing again the story of interest rate risk. The textbook has a little example that's a good example of the issue of interest rate risk. It occurs in the section of the chapter 6 under holding period returns. And the textbook tells a story about a $100 10-year 6% coupon bond and what happens if the prevailing market interest rate changes unexpectedly after the bond has been bought. Now, I also have an example in my lecture notes. I think actually my page 51 lecture notes example is less clear than the example in the textbook. So read the textbook example. It explains fairly clearly what we mean by interest rate risk: unexpected capital gain, unexpected plus or minus. See you next time.